So I want to talk about something that I feel like a lot of us have had on our mind lately, and that is, when is the next stock market crash going to happen? For more than 13 months, investors have been enjoying a record-breaking bounce-back rally since the S&P 500's bear market low on March of 2020, returning 87% since that time. In fact, the market right now is historically overvalued. The S&P 500's Shiller price-to-earnings ratio is around 37, and this is a measure of average inflation-adjusted earnings over the last 10 years. Not only is 37 more than double the average Shiller PE for the S&P 500 since 1870, but anytime the Shiller PE has remained at a level above 30 throughout history, the market has swiftly declined. In the previous 4 instances of the Shiller PE topping 30 during a continuous bull market, the S&P 500 lost between 20% and 89% of its value. And if you're not familiar with stock market valuation ratios, then to put it simply, stocks are very expensive right now and will have to come down in the future. So even though nobody can know for sure when exactly the next market crash is going to happen, we can always prepare and take advantage for when it does happen. So that's why I wanted to make this video about the 5 different ways that you can prepare yourself for the next market crash and how to make the most money possible during one. So if you find this video helpful and informative, then make sure to hit that like button and hit subscribe as well for more content. So the first thing you should do is lower your costs and save as much money as you can. This is the fundamental step that will put you in a great cash position to be able to take advantage of the lower values during a market crash. You should open up a high interest savings account if you haven't done so already, and this is just somewhere to store your cash whilst you decide what you want to do with it. I personally use Marcus by Goldman Sachs, and I've had a great experience with them, but I've also heard great things about Ally Bank and Discover savings accounts. These savings accounts are currently only paying an interest rate of around 0.5% annually, since interest rates are just very low right now. But once again, the idea isn't to make money from this. It's just a better alternative to keeping your money in a checking account that pays you no interest on your money. And if you don't already have a high interest savings account, then from now on, you'll know to keep most of your spare cash in a savings account. Your first goal with saving money should be to have an emergency fund that covers 3 to 6 months of your essential expenses. And I know that you're thinking that that's quite a lot of money to keep on the side. But let's say if your expenses are around $3,000 a month, you might need to have around $15,000 saved up. And I know that most of us are tempted to keep less than that because there's the opportunity cost of what we could be doing with that money, instead of keeping it in a savings account earning little interest. But I honestly think that now is more important than ever to stick to that 3 to 6 month expenses rule. During a recession, unemployment increases substantially and affects every single industry negatively. So please just keep your emergency fund ready, because you never know if you'll be out of a job for 6 months or more and have to take just any job you can find that probably won't pay as well as your last job. Also, considering 70% of people don't have $1,000 of emergency funds, I have a feeling that the majority of you should at least set aside a few months of expenses. After you have an emergency fund, you should be saving everything you can so you have money to invest during a recession. Okay. So assuming you have an emergency fund saved up and now you're looking to grow your money, now I'm going to talk about a few investment alternatives you might want to consider. The second method of making money during a market crash that I wanted to talk about is, of course, investing in stocks. A market crash is going to bring about low stock prices, and we want to buy them at these discounted values. So the 2 main questions you might have is, what stocks should I buy during a market crash and when is the right time to buy them? Well, I recommend investing into 3 different stock investment vehicles. And the first is index funds. An index fund is a fund with a portfolio which is made to match or track the components of a financial market index, such as the S&P 500. So to explain this more simply, the S&P 500 is an index that is made up of 500 of the biggest and best companies in the United States, diversified across multiple industries. These industries include things like technology, real estate, energy, all that sort of stuff. And the S&P 500 is widely considered one of the best representations of the US stock market and has returned an average annual return of 9.8% since its creation in 1926. So by investing in index funds such as Vanguard's VOO ETF, which tracks the performance of the S&P 500, your investment would get exposure over 500 large companies over various industries. And this is much better than investing in just one stock or a couple different stocks, because we get the benefit of diversification. So now you're not at risk at investing into, let's say, one particular airline company and having that company go bankrupt and lose all of your money. The second great investment is a Roth IRA account. And this is a retirement account in which you can contribute $6,000 annually. You open a Roth IRA account at a bank or a brokerage and select what you want to invest in, such as mutual funds, stocks, bonds, and ETFs like the one from Vanguard that I mentioned earlier. And this is such a great long-term investment because your contributions grow tax-free, and you can also withdraw money from your account tax-free when you're over the age of 59 and a half. If you withdraw before, you will generally have to pay taxes and a 10% penalty on your earnings. So this is only a great option if you plan to invest long term, which is what I recommend. And finally, the last investment I recommend is investing into your traditional 401k retirement account, which is a tax-advantaged account that most employers offer to their employees. It essentially works similarly to a Roth IRA, but instead you can contribute with your pre-tax earnings. And your investment grows tax-free, and you only pay taxes on it once you withdraw from it during your retirement. This is most likely the best investment option if your employer offers a match to a certain amount of your contributions. For example, if your employer offers a 3% match, then that means that your employer will match what you contribute into your account up to 3% of your salary. This is essentially making an instant 100% return on your investment up to 3% of your salary. So if your employer offers a match, at least invest up to the match. Otherwise, you're just refusing free money. Okay. So now that we know about some good investment options, the next question is far more controversial, which is when to invest during a recession. So there are two main theories when it comes to figuring out when to invest. The first theory is called dollar cost averaging, which is when an investor makes regular purchases of an asset, spaced out over regular intervals of time to reduce the impact of market volatility. So for example, if I wanted to invest $12,000 over the next 12 months, I would invest $1,000 every month, regardless of whether the stock market had just gone up or down. And by doing this, I would get the average return of the stock market during that year. So by spacing out your investments and only investing a small portion each time, dollar cost averaging aims to avoid making the mistake of making one lump sum investment that is poorly timed, such as investing the $12,000 all at once right before the market goes south. The other school of thought when it comes to deciding when to invest is called timing the market. Timing the market is an investment strategy that involves buying and selling investments by attempting to predict the future movement of the market. So basically, if you think that the stock market will go up, you buy stocks because you think the price is low. And if you think the market will go down, you sell your investments whilst you think the price is high. I recommend using the dollar cost averaging approach, since studies have shown that this is more effective than trying to time the market. For example, imagine you were trying to time the market and you invested all of your money when the stock market declined by 10%. You might be feeling pretty pleased with yourself because you're buying stocks at 10% cheaper than they were a little while ago. But since you can't predict how low the stock market will drop, let's imagine the market declines another 30% after you've already put your money in. Well, then you would already have lost a lot of money in comparison to if you had dollar cost averaged by investing your money at regular intervals as the stock market declines so that you get in at an average price during the market crash. Okay, so moving on from stocks, let's talk about the third way to make money during a crash, which is real estate. Real estate prices are still at an all-time high right now and have the risk of dropping considerably. And any drop in real estate will lag any decline in the stock market because it would likely take several months for people to default on their mortgages, tenants stop paying rent, so landlords default on their mortgages, prices falling as a result of a decrease in buying activity, also known as demand for purchasing real estate, and for most banks to start tightening up their lending standards. Taking advantage of low real estate values is probably the best thing that you can do to secure your financial position for the rest of your life. Anyone that bought a house following the Great Recession of 2008, when real estate was extremely cheap, would likely have hundreds and thousands of dollars of equity in their home right now. So like I said earlier, banks tighten up their lending standards during times of economic uncertainty, making it harder to qualify for a mortgage and thus buy a house. So it's really important to appear as safe a borrower as possible in the eyes of your lender. This means that you might need to have a larger than normal down payment to put down on your house. And that really comes back to you needing to save as much money as possible. You'll also need to ensure that you have a good credit score and a low debt to income ratio, which brings me into method number 4 for making money during a market crash, which is reducing your debt. If you have any high interest debt like credit cards that has a 10 to 20% interest rate, please pay those down first before investing any money. It's hard to find an investment that gives you a 10 to 20% return on your investment, so it's much better to just pay those debts down. And also, paying down debt is risk-free. Another way to reduce your debt and save more money during a crash is to refinance your mortgage if you own any real estate, even though mortgage rates are low. In fact, by historical standards, they're ridiculously low. But believe it or not, they could could fall even further. In fact, last year, Fannie Mae economist Doug Duncan told the Dallas Morning News that he expects mortgage rates to slide even further if the economy slips into a recession. So refinancing your existing mortgage or even getting a new mortgage during a recession might save you a lot of cash via a lower mortgage rate. Okay. So now moving on to the last method of making money during a recession, and that is investing into what's viewed as a hedge or safe haven investment, such as precious metals and cryptocurrencies such as Bitcoin. Precious metals such as gold and silver have historically performed well during times of economic uncertainty, as the dollar is threatened and investors move into the most ancient, universally accepted form of money. Also, cryptocurrencies such as Bitcoin and Ethereum have performed very well in the last year since the pandemic. And some people believe that this argues that crypto has taken the spotlight in terms of replacing precious metals as a hedge against traditional fiat currencies. It's also worth mentioning that since the Federal Reserve has become a big fan of printing money since the pandemic, a process known as quantitative easing, this adds to the argument that these alternative investments will perform even better than they ever have before. This is because if the Federal Reserve continues to pump stimulus into the economy as a way to prevent or reduce the impact of a market crash, they will likely create inflation, which devalues the US dollar, which causes more investors to hedge against it. So those are my 5 ways for you to make money during the recession. I hope you guys found this video informative, and if you did, please hit the like button and comment when you think the next market crash is going to be. I'll be doing a lot more videos just like this and just like personal finance topics and all that sort of stuff, so if you're interested in that, subscribe for plenty more content. Take care and see you later.